Hey everyone, welcome back to Corporate Decoded, the place where we uncover the hidden stories in corporate filings. And let's just say this latest filing from American Assets Trust Incorporated is packed with numbers that might make your head spin. But hey, that is what we're here for, right? So buckle up because we are about to decode the financial health of American Assets Trust Inc. Pareted and its operating partnership for the year ending the 31st of December 2025 will check out their property portfolio, their revenues, their risks, and see if they are truly the asset kings they claim to be. Let's dive straight into the numbers on page 56. The total property revenues took a hit, decreasing by about 5% from around $458 million in 2024 to $436 million in 2025. This dip isn't ideal, and it means they brought in nearly $22 million less revenue from their properties compared to the previous year. And when we look at rental income specifically, things are a bit softer there, too, dropping by 3% from $424 million in 2024 to $410 million in 2025. This smaller rental income is a key reason for the overall revenue decrease, and it shows that rents or occupancy might not be growing as fast as before. Now, they also saw a big drop in other property income, falling by 25% from $34 million in 2024 to $26 million. In 2025, in 2024, they had a significant one-time boost from a net settlement payment related to building specifications that did not repeat in 2025, so it's good. They got that money, but it makes the year-over-year comparison look worse than it might otherwise. Putting it all together, property operating income, which is basically the profit from their direct property operations, fell by 8% from $290 million in 2024 to $267 million in 2025. This is a pretty noticeable drop, and it means that after covering property expenses, they made less money from their buildings. Looking at the different property types, the office segment saw a significant 9% decrease in its operating income, falling from $153 million to $139 million. This drop in office income was partly because they received a big payment in 2024 from a tenant vacating a property, which did not happen in 2025, but even without that one, time event, lower occupancy, and increasing operating costs are also playing a role. The retail segment saw its operating income decrease by 11% from $77 million to $68 million. This is largely because they sold one of their retail properties, Del Monte Center. It's good that they sold it for a profit, but it means less income from that property going forward. On a brighter note, the multifamily segment saw a slight increase in operating income with a 1% rise from $37 million to $37 million. This stability is good, especially considering they acquired a new property, Genesee Park, which likely offset some minor declines in occupancy elsewhere. Now, expenses are always important. Property taxes went up by 2% from about $44 million to $45 million. This might not sound like much, but it is an increase in cost they have to bear. The office segment saw the biggest jump in real estate taxes, up by 9%, mainly because some properties were no longer being developed, and therefore their taxes were being expensed instead of capitalized. Looking at their debt interest expense, went up by 5% from $74.5 million in 2024 to $78.1 million in 2025. This increase is mainly due to taking on new debt and not being able to capitalize as much interest anymore because some development projects are finished. Here is a really interesting financial highlight on page 56. They reported a gain on sale of real estate of $44.5 million. This is because they sold the Del Monte Center property in February 2025 for about $123.5 million, selling assets for a profit. Can boost earnings, but it also means they no longer have that property generating ongoing income. And what does all this mean for the bottom line for American Assets Trust Incorporated stockholders? Net income dropped slightly by 2% from $56.8 million in 2024 to $55.6 million in 2025. So while they had a big gain from selling a property, other factors like lower rental income and higher interest expenses pulled the overall net income down a bit. Let's also look at net operating income, or NOI, which is a key measure for real estate companies. NOI decreased by 8% from $290 million in 2024 to $267 million in 2025. This measure helps us see the core profitability of their properties before things like corporate overhead or interest payments are factored in. The drop here reflects the challenges in their office and RET. ALE segments. And for investors who follow REITs, funds from operations, or FFO, is crucial. FFO dropped by about 22% from $198 million in 2024 to $154 million in 2025. This significant decrease is mainly due to that gain from selling the Del Monte Center property, which is excluded from FFO calculations. So while the Company made money from the sale, it does not count towards their ongoing operational performance. Now about their cash situation, cash and cash equivalents decreased significantly from $425.7 million at the end of 2024 to $129.4 million at the end of 2025. This big drop is mainly because of substantial debt repayments and some acquisitions. Looking at their contractual obligations on page 64, we see a really big number for principal payments on long-term indebtedness. Totaling $1.7 billion, a huge chunk of that $1.025 billion is due more than 5 years out, but a significant $425 million is due within the next 2 years. Now let's talk about risks, because no company is without them, the filing lists. Many risks, but a big one for them is their heavy reliance on regional economic conditions, especially in California, Washington, Oregon, Texas, and Hawaii. They are also very exposed to market trends in the office, and retail sectors with concerns about work from home impacting office demand, and co-tenancy clauses affecting their retail properties. They specifically mention that work from home flexible schedules and video conferencing have become common, and this might reduce the demand for office space, leading to lower rents and property values. This is a serious concern that could impact a big chunk of their business. Competition is another major risk. They face a lot of competition for good properties, which can drive up prices and reduce opportunities. Essentially, they have to fight hard to find and buy good real estate, which can be a challenge. And of course, for a REIT, maintaining that special tax status is critical. They have strict rules to follow about income and distributions. Failing to meet these rules could lead to massive tax bills, which would seriously hurt their ability to pay dividends and operate their business. So what is my take on American Assets Trust Incorporated? Well, they definitely sold a property for a nice pro. TART in 2025, which is a positive, but their core rental income and operating performance are showing some weakness. The drop in FFO is a sign that their ongoing business operations are not as strong as the previous year. Their heavy debt load and the risks associated with their concentrated portfolio in specific markets and sectors like office and retail are definitely things to watch the trend towards. Moat work is a particular challenge for their office segment, and while they are diversifying with multifamily properties, it is not enough to completely offset the headwinds. Overall, American Assets Trust Incorporated is facing some headwinds. The sale of Del Monte Center provided a good financial boost for 2025, but the underlying business performance in their office and retail sector ours needs improvement. They have a lot of debt and are in competitive markets. So continued focus on smart acquisitions and managing existing properties effectively will be key to their future success. What is your take on their financial performance and the risks they face? Let us know in the comments below. If you found this deep dive into American Assets Trust helpful, please hit that like button. It really helps us out, and subscribe to Corporate Deco for more breakdowns like this, and don't forget to join our Discord community linked in the description below for even more exclusive content and discussions. Thanks for watching. See you next time.